Welcome to the Deep Dive. We're here to sift through stacks of research, articles, and data to pull out those key insights, those aha moments, just for you, our learner.
And today we're starting in early 1900s Cincinnati. Think about this. John Payne, a telegraph operator, gets fed up. Western Union takes this sudden moral stand against gambling.
So what does he do?
He quits and starts his own company, Payne Telegraph Service.
Just like that. But it wasn't just any service, was it?
No, not at all. This thing, reporting horse race results, it gave bookies this incredible edge, a massive information edge.
How so?
Well, imagine knowing a horse had already won or lost
Yeah.
before you take the bet. You accept the losers, reject the winners instantly.
Okay, so that's the beginning, weaponizing information for profit, basically.
Exactly. That's the seed. And our mission today is to really unpack how that initial chase for an edge
Yeah.
in the shady world of gambling, how it grew
Right, how it got supercharged by mathematicians, information theorists.
and collided with organized crime's ambition, and eventually just completely changed Wall Street. It's quite a story arc.
It really is. We're going to explore how knowing about information randomness, risk, how it can lead to huge fortunes or just total disaster.
And the key thing for you, our learner, is what you can take away from all this. How to make better decisions when you're just floated with information every day.
Okay, so let's dive in. John Payne's wire service, it took off, didn't it? Even with crackdowns.
Oh, yeah. Like in Chicago, Mayor Carter Harrison II, he bans all racetrack betting, declares he wants the sport of kings without the vice of kings. Noble goal, right?
You'd think.
Yeah.
But the actual effect, totally the opposite. Track attendance just tanks.
And illegal bookmaking.
Explodes. So the sport of kings really did become the vice of kings, and everyone else too, betting off track. The demand for those quick results was just enormous.
And that kind of money, especially illegal money, it attracts attention. Which brings us to Montanus.
Right. Montanus, Chicago gangster.
Huh?
Around 1907, he gets Payne's Illinois franchise, renames it the General News Bureau. Smart move. How much did that cost him?
Cost him $300 a day, which sounds like a lot back then, but he made it back many times over. He had, over 700 bookie joints just in Chicago?
Wow.
And he demanded half their daily take. Half.
That's serious money. No wonder he was a target. I read he survived 6 bombings in 1907 alone.
6, yeah. And when a reporter asked him, do you know who's doing this? Tennis apparently just said, yes, of course I do, but I'm not going to tell anyone about it, am I? That would be poor for business.
Yeah.
Incredible nerve.
Unbelievable. So Tennis forces Payne out eventually.
Yep. Squeezes him out completely, expands the General News Bureau nationwide. His reign ends, but the wire service just keeps going.
And then Mo Annenberg enters the picture, publisher of Racing Form.
That's him. By 1927, Moses Mo Annenberg is the biggest stockholder in the General News Bureau. And he wasn't shy about it. He argued people should be allowed to bet away from the track if they couldn't get time off work.
The public service, almost.
Huh. Yeah, something like that. But what's really wild is AT&T's role in all this.
The phone company. How were they involved?
Well, Annenberg didn't own the wires themselves. He leased the lines, the equipment, everything from AT&T.
Seriously, even though they must have known it was for illegal gambling.
Oh, they knew. Their own lawyers warned them back in 1924 that these services were clearly serving pool rooms and bookmakers. But they kept leasing the lines anyway.
Why? Just the money.
Pretty much.
Ah.
They added an escape clause to the contracts, for plausible deniability.
Yeah.
But by the mid-30s, Mo Annenberg was AT&T's 5th largest customer.
5th largest? That's staggering. The scale is just immense.
It tells you how much money was flowing.
Yeah.
And of course, that kind of profit brings mob attention.
Right. The competition heats up. Tell me about John Lynch.
Okay, so Lynch, another Chicago mobster, actually owned stock in the General News Bureau. He ends up taking Annenberg to court.
How did that work out?
Annenberg's lawyer pulled this incredible move. He argued that since the whole business was illegal, the court couldn't rule on a dispute within it. He even cited this old English case about highwaymen arguing over loot.
And the court bought it.
They did. Unbelievable, right?
Yeah.
So the legal system couldn't touch it.
So Lynch needed other methods.
Exactly. He turns to Al Capone's mob. They'd already tried to muscle in on Annenberg. Capone's guy, Frank Nitti, even threatened Annenberg's life.
High stakes.
Definitely. Negotiations went on for years. Finally, Annenberg agrees to pay Capone $1 million a year. Protection money.
$1 million a year, but then Annenberg gets out.
Yeah, in 1939, he's facing tax evasion charges, wants to look clean, So he walks away from the wire service,
leaving a vacuum.
which gets filled instantly. It reforms his Continental Press service, run by Annenberg's associate, James Rugham.
Did Reagan play ball with the mob?
No, he actually kept his distance. He even prepared affidavits against Nitti, sort of like an insurance policy.
Smart, but risky.
Very. And it led to the combination. This big alliance of Italian and Jewish mobsters setting up their own rival wire service, Trans-American Publishing and News Service.
And who was running Trans-American? Anyone famous?
You could say that. Ben Siegel, better known as Bugsy, though apparently he hated that nickname.
Bugsy Siegel. So he gets into the wire game.
Yep. His territory included Nevada, where gambling was legal. And he had this really aggressive model.
What did you do?
He didn't just charge casino bookies a subscription fee. In some cases, he demanded up to 100% of their bookmaking income.
100%? How did he justify that?
His logic was, hey, these bookies are drawing people into the casinos anyway, so the wire service deserves the maximum cut. Pretty bold.
Until his famous exit.
Right, his very public murder in 1947, clearly an execution. After that, the combination took full control of his wire service, too.
Eventually, this all has to come crashing down, or at least face public scrutiny, right?
Absolutely. Enter Senator Estes Kefauver. He famously brands Continental Press public enemy #1.
Why #1?
Kefauver argued it was the absolute lifeblood of the entire illegal gambling empire, which then funded all sorts of other crime across the country.
And the Kefauver hearings themselves became legendary television, didn't they?
Oh, completely. Frank Costello, the big crime boss, agrees to testify, but only if they don't show his face.
Yeah.
So the cameras focus on his hands. It becomes this bizarre hand ballet.
I've heard about that. And Longies Willman?
Yeah, Abner Longies Willman, New Jersey gangster, arguably the real power behind the combination. He plays it cool, presents himself as just a legitimate businessman,
Denies everything.
calmly denies knowing other mobsters, complains about the flashbulbs, I feel like I'm getting shot, quips about his past. In the old days, I met everybody. Just deflects everything.
Did they talk about Willie Moretti, his associate?
They touched on Moretti, yeah, who was later killed. But Kefauver's big conclusion was fascinating.
What was it?
He concluded the most powerful crime figure in America wasn't Italian mafia, but Zwilman, who was Jewish.
That shook things up.
And the impact of the hearings.
Huge public outcry against gambling led directly to new federal laws banning interstate transmission of gambling info, which really hit the wire services hard.
Okay, so let's pause there. What's the big picture from this early history? It shows really clearly how controlling the flow and, crucially, the speed of information created these massive fortunes and immense power, even completely outside the law.
It set the stage.
Exactly. It set the stage for much more sophisticated ways to get that edge. Which brings us to how we even define information itself.
Right. And for that, we need to talk about a very different kind of genius, Claude Shannon.
Claude Shannon.
Yeah.
A quiet guy, apparently hated publishing, hated giving talks, but his ideas, they're literally the foundation of almost all our modern digital tech.
His first big breakthrough was about computers, right? Using binary.
Yeah, he showed how computers could use just zeros and ones, basically on-off electrical signals.
Yeah.
And he proved these simple circuits could compute anything using Boolean logic.
Boolean logic. That's like true, false, and or, that kind of thing.
Exactly, like a complex set of switches that can solve any logical problem. It was a huge leap from the mechanical calculators they had back then.
And then during WWII, this top-secret project, Sigsaly, he worked with Alan Turing on that.
That's right, Project X, only declassified decades later. They built this secure voice scrambler, Sigsaly. And the really interesting part for information theory is how it worked.
How did it work?
It used random white noise, basically static recorded on vinyl records, to mask the voice signal, created this indecipherable hiss.
So the randomness was key.
Totally. Shannon later said something like, a secrecy system is almost identical with a noisy communication system. The randomness made it secure. It let Allied commanders talk freely. Vital stuff.
But Shannon's most radical idea, the one that really shakes things up, is that the meaning of a message doesn't matter for information content. How does that work?
It sounds backwards, I know. But for Shannon, information isn't about semantics. It's about probability, unpredictability, surprise.
Surprise.
Yeah. The more unexpected, the less probable a message is, the more information it carries.
Yeah.
Think about that Shamu commercial example you mentioned.
Right. The guy brings home a killer whale instead of shampoo.
Exactly. The humor is in the sheer improbability. A killer whale is a very low probability message in that context. So when it does happen, bam, lots of information. For Shannon, the essence is improbability.
He had a sense of humor about it too, right? The whole entropy thing.
Oh, yeah. The story goes, the brilliant mathematician John von Neumann told him to call his measure of uncertainty entropy.
Why entropy?
Well, partly because it's a term from physics for randomness or disorder. But von Neumann supposedly joked that Shannon should use it because no one really knows what entropy means, so he'd always win any argument.
Ah, did Shannon use it?
He did, loved it. Even named his house Entropy House. Apparently it was pretty chaotic inside, so the name fit perfectly.
And his legacy today is just everywhere.
Everywhere. His work on error correction, that's why your computer files don't usually get corrupted, why programs don't crash constantly from tiny errors in data transmission. Someone summed it perfectly. No Shannon, no Napster.
Or no streaming, no cloud storage, none of it.
Pretty much. His abstract theories built the digital world.
So why does this matter so much for you, our learner?
Because Shannon gave us the tools, the actual language, to quantify uncertainty, to measure that edge we keep talking about. He let us analyze unpredictability, whether it's in code breaking or, as we'll see, in financial markets.
Okay, so Shannon lays the theoretical groundwork. Then another Bell Labs guy, John Kelly, connects it directly to gambling.
Directly. John Kelly, he saw the link, famously said, gambling and investment differ only by a minus sign, which is a pretty radical statement.
Suggests the math is the same underneath.
Basically, yeah. Though Bell Labs got nervous, they were still touchy about those old bookie connections.
So they made him change the title of his paper?
Yep. It was originally Information Theory in Gambling. They made him change it to something much drier. A new interpretation of information rate. Shows you how sensitive the whole topic was.
And then along comes Ed Thorp, MIT math instructor, uses a giant IBM mainframe.
An IBM 704, yeah.
To crack blackjack, develops his winning strategy. That must have caused a stir.
Huge stir. He got thousands of letters. His department secretaries were totally overwhelmed. People wanted the secret. His system really did beat the house.
But the story gets even crazier. Shannon and Thorp worked together. Secretly.
Yes, this is one of the wildest parts. They secretly built a portable roulette prediction device. A wearable computer, essentially.
How on earth did that work?
Okay, get this. It timed the speed of the wheel and the ball as they spun. Then it calculated which section or octant, like a 10-pocket slice, the ball was most likely to land in.
And how did it tell the user?
Through musical tones, little notes do, re, mi, fa, sol, la, ti, do, sent through a tiny hidden earpiece. The wires were incredibly thin, like hairs glued to Thorpe's skin, painted to match.
That's insane. Did it work?
They estimated they had a 44% edge over the house with it, 44%, but it was incredibly risky. Shannon was terrified of getting caught, worried about connections to casino bosses, mob reprisals. The whole thing had to be top secret.
Incredible. But, okay, even if you have a 44% edge, there's still this problem. Gamblers ruin. Most people go broke anyway, right?
That's the tragic irony. Gamblers ruin. Even with an advantage, bad money management can wipe you out. Think of Casanova.
The famous lover, what did he do?
He used the martingale strategy, doubling bets after every loss. Sounds logical, but it's disastrous. He lost his mistress's diamonds trying to recoup losses. It guarantees eventual ruin if you hit a long losing streak.
And there are darker stories, too.
Oh, yeah. There's a grim tale from Reno about a woman addicted to faro. She ended up selling herself for 50 cents a pop, the minimum bet, just to stay at the table. It shows how devastating poor bankroll management can be.
So how do you avoid gambler's ruin if you do have an edge? This is where Kelly comes back in.
Exactly. Thorpe adopted John Kelly's formula, the Kelly Criterion. It tells you how much of your bankroll to bet based on your perceived edge.
So it's not just if you have an edge, but how big it is.
Precisely. And crucially, Kelly betting means you never bet your entire bankroll. You bet a fraction. So even after losses, you still have capital to continue. Your bet size shrinks when your bankroll shrinks and grows when it grows. It's designed for long-term capital growth and survival.
Makes sense. But the casinos weren't just going to let Thorpe and others walk away with their money, right? What did they do?
No way. They fought back hard. Places like Harold's Club in Reno had massive surveillance guys behind one-way mirrors watching everything.
And changing the game?
Oh, yeah. Dealers were told to shuffle the deck much more frequently, sometimes after only a few hands, to disrupt card counters, like Thorpe. He talks about dealers shuffling 15, 25, even 42 cards from the end just to mess them up.
Any rougher tactics?
Definitely. Thorpe encountered knockout dealers, guys who would blatantly cheat by dealing seconds if they suspected you were counting. He even suspected being offered poisoned coffee once to throw him off his game.
Poisoned coffee? Wow.
And casino bosses were apparently meeting up, talking about breaking a few legs to scare off counters. It was a real battle.
So what's the key lesson here for our listener from Thorp, Kelly, and the casinos?
It's this critical link between finding an edge, the math, the system, like Thorpe did, and managing the risk that comes with it, which is what the Kelly Criterion helps with. You need both. An edge without risk management often leads straight to ruin. That applies way beyond casinos.
Okay, so let's shift the theme. From casinos to Wall Street, the stakes get even higher. This idea that stock prices are random, it's actually pretty old, isn't it?
Surprisingly old. Louis Bachelier, French mathematician, wrote his thesis in 1900, arguing stock prices follow a random walk, like a drunk staggering randomly, fundamentally unpredictable.
Paul Samuelson refined that.
Yeah, the famous economist. He pointed out the obvious flaw: prices can't go to low zero, unlike a truly random walk. But the core idea stuck.
And this led to the efficient market hypothesis, EMH.
Right. Eugene Fama's big idea. Basically, competition is so fierce in markets that prices already reflect all known information. You can't consistently beat the market because any news is instantly priced in.
There's even a strong form of EMH.
Yeah, the strong form says even private inside information won't help consistently because the market's that efficient. Samuelson even joked that if markets were truly efficient, most money managers should just quit and become plumbers or something.
But if markets are efficient, how does anyone make real money consistently? Is there a way around it?
Well, the counter-argument often involves arbitrage.
Arbitrage, what's that exactly?
It's spotting and exploiting market irrationality, usually by buying and selling basically the same thing at slightly different prices in different places or forms at the same time, locking in a tiny, almost risk-free profit.
Like Jay Gould buying gold cheap in one city and selling it high in another.
Exactly like that. Claude Shannon himself, the information theory guy, believed arbitrage was the real way to make money in markets, finding those moments where the numbers just don't line up correctly.
But Shannon's own investing style wasn't really like that, was it? He wasn't a rapid-fire trader?
No, ironically, he wasn't. He was a classic buy-and-hold fundamental investor. He looked for companies with strong earnings growth, ignored what he called the noise of technical analysis, charts and patterns.
And he did well.
Amazingly well. His investment in Harrison Labs, which HP bought, it returned something like 29% a year for over 30 years, turned his initial stake into 3,500 times the amount. His edge was patience and fundamental insight, not fast trading. He thought commissions would kill any active strategy anyway.
Okay, but Ed Thorp, the blackjack guy, did apply his math directly to finance, starting with warrants.
Yes, Thorpe jumped right in. Warrants are like long-term options on stocks. And he found they were often completely mispriced. Priced like carnival games, he said. People consistently overpaid for them.
So he developed a system.
He developed a hedging system, a way to structure trades to profit from the mispricing while minimizing the overall market risk. He turned $40,000 into $100,000 in just 2 years using it.
Hedging, that's key, right? Reducing risk.
Absolutely. It's about offsetting your bets. And this led him and James Regan to start Convertible Hedge Associates, one of the very first hedge funds.
The term came from Alfred Winslow Jones in '49, right? What was their goal?
They aimed for market-neutral returns, meaning they wanted to make money whether the overall stock market went up, down, or sideways. Profit from the relative price differences, not the market direction.
And didn't Warren Buffett invest with them?
He did. Met Thorpe at a bridge game, apparently, became an investor. And Thorpe famously predicted Buffett would become the richest man in America.
Which he did. How did their fund, Princeton Newport, actually perform?
Phenomenally. Between late '69 and the end of '73, a period when the Dow actually lost value, their fund gained over 100%. Thorpe tracked it. 190 out of 200 hedge trades were profitable. It blew apart that old idea that you must take on more risk to get higher returns.
What about a real stress test like Black Monday in 1987? The market crashed huge that day.
Yeah, the Dow dropped 23% in one day. Princeton Newport. Their $600 million portfolio lost only about $2 million. Tiny fraction. And get this, Thorpe actually made $2 million on new trades during the crash. They ended the month flat and the year up 34%. Just incredible risk management.
So the takeaway here for you, our learner,
it shows that even if markets tend towards efficiency, smart analysis and tools can find and exploit gaps. And crucially, it introduces hedging as a way to manage risk and potentially achieve better risk-adjusted returns. You don't always have to risk more to gain more if you're smart about it.
Okay, this leads us nicely into a really deep, almost philosophical debate. Utility versus growth. Let's go back to that St. Petersburg paradox. the coin toss game where you should win infinite money.
But nobody would pay much to play it.
Right.
What's the core paradox there?
It's that mathematical expectation what you should win on average totally clashes with how real people value money and risk. Infinite expected dollars doesn't translate to infinite willingness to pay.
And Daniel Bernoulli, way back in 1738, he had an explanation.
He did. He introduced the idea of utility. Basically, the subjective value or satisfaction you get from money isn't linear. It diminishes.
Meaning that first dollar when you're broke is hugely valuable. The billionth dollar, not so much. An extra $1,000 means way more to a student than to a billionaire. That diminishing return on happiness or utility is what logarithmic utility tries to capture mathematically.
But Bernoulli's original paper, the one that's often missed, focused on something else for evaluating risky bets, right? The geometric mean.
Yes. This is crucial. He argued you shouldn't just average outcomes, the arithmetic mean. You should use the geometric mean.
How's that different, and why does it matter?
Okay, arithmetic mean is simple average. Add up returns, divide. Geometric mean involves multiplying outcomes and taking the root. Think about it. If you gain 100%, then use 50%, your average looks like plus 25%. But you're actually back where you started, zero growth. The geometric mean correctly shows zero growth.
Ah, so it reflects the compounding effect over time.
Exactly. It almost always gives a lower, more conservative number than the arithmetic mean. For Bernoulli, it captured nature's admonition to avoid the dice. It reflects the true long-term growth potential, or lack thereof, when you face repeated risk. It's about survival and actual wealth accumulation over time.
And connecting this idea, geometric mean maximization, to the Kelly Criterion.
Yeah.
That sparked a huge academic fight, didn't it? The Kelly Criterion feud.
Oh, big time. Paul Samuelson, Nobel winner, heavyweight economist, he absolutely hated the idea of individuals maximizing the geometric mean using Kelly.
Why?
He thought it was too focused on perpetual risk-taking, too greedy. He argued people should invest based on their personal utility, their subjective comfort with risk. He even wrote this bizarre paper using only one-syllable words to argue against it.
Seriously, one-syllable words.
Yeah. Why we should not make mean log of wealth big those years to act are long. He felt Kelly was importing a flawed concept from information theory into personal finance.
And the pro-Kelly side, Thorp, Latane, Cover, what did they say?
They basically said, look, we're not talking about subjective feelings. We're talking about objective math. Which system makes you richer in the long run? They argued that the strategy maximizing compound growth is objectively superior, regardless of short-term feelings. It's about maximizing the actual dollars.
This leads to that Joneses versus the Kellys idea, right? Can you explain that?
It's a great way to think about it. The Joneses invest for specific goals, driven by utility, maybe saving for a house, retirement income. They probably diversify a lot to feel safe day to day.
Okay. And a Kellys.
The Kellys are different. They focus solely on maximizing the long-term compound growth rate of their wealth, using something like the Kelly Criterion. They don't care as much about short-term bumps or specific goals, just the overall growth trajectory.
And the result over time.
Over the long haul, the Kellys almost inevitably end up much, much wealthier than the Joneses. The math of compounding just takes over. It's optimizing for growth versus optimizing for comfort or specific milestones.
But using Kelly isn't risk-free, right? What does it mean for your actual money, your bankroll?
Definitely not risk-free in the short term. In theory, if you bet perfectly according to Kelly, there's a 50% chance your bankroll will, at some point, drop to half its starting value.
50% chance of losing half your money temporarily. Ouch.
Yeah, and about a 1% chance of being down to just 1% of your initial stake. It recovers, mathematically, but you have to stomach those drawdowns. Ray Dillinger called Kelly the bright, clear line between aggressive investing and insane investing.
So it's aggressive, designed for maximum long-term growth, but requires serious tolerance for volatility.
Exactly, which is why it's controversial. Some gamblers call it the Kevorkian criterion financial suicide. Others think geniuses like Warren Buffett are essentially crypto-Kelly traders, intuitively betting big only when they see a massive edge, focusing on long-term compounding.
So, this whole debate, utility versus growth, it really forces you, our learner, to think about your own approach. Are you a Jones, focused on specific goals and comfort, or a Kelly, aiming for maximum long-term wealth, even if it means a bumpy ride? Kelly offers the math for the latter, but you need the stomach for it. Okay, no deep dive is complete without looking at when things go wrong. The dark side. Hubris. Downfall. Let's talk about Rudy Giuliani.
Right, Giuliani, back when he was U.S. attorney. He famously used the Ikakale Act racketeer-influenced and corrupt organizations against mob bosses. The name Ito supposedly inspired by an old gangster movie character.
But then he turned that same weapon against Wall Street.
He did. He saw the parallels. He said these elite Wall Streeters involved in insider trading were connected by the same things as the mob. Friendship, power, money, information. A different kind of social network.
And Ivan Blodetsky was right in the middle of it?
Absolutely central. Ivan Blodetsky. His game was risk arbitrage, but really he was trading on inside information, often from guys like investment banker Martin Siegel.
And using massive leverage.
Huge leverage. Claimed 9-to-1. Borrowing $9 for every one of his own.
Yeah.
Famously gave that Berkeley speech saying, greed is all right.
And the way he handled the payoff.
Cloak and dagger stuff, briefcases stuffed with cash, tied with ribbons from Caesar's palace, dropped off secretly. Just blatant insider trading.
How did Giuliani bring him down?
It started with another trader, Dennis Levine, getting caught. Levine implicated Blodetsky. Blodetsky then cooperated, wearing a wire, and implicated Siegel.
And Siegel implicated others.
Yes, Siegel implicated Robert Freeman at Goldman Sachs, and Giuliani's team made a point of arresting Freeman very publicly handcuffed in his fancy office. The message was clear. White-collar crime won't be tolerated no matter how high up you are.
And somehow this connects back to Thorp's fund, Princeton Newport.
Yeah, a real 6 degrees of separation thing. Thorp's partner, James Regan, had been college roommates with Robert Freeman. That connection put Princeton Newport on the investigators' radar.
What were they accused of?
Stock parking. Basically, transactions designed to hide ownership or dodge taxes, buying securities with secret agreements to sell them back later.
And the investigation led to that dramatic raid.
Oh yeah. 50 armed FBI agents stormed their offices, seized 300 boxes of documents. They were specifically looking for audio tapes of trades.
Was Thorp charged?
No, Thorp himself wasn't charged with anything. But Regan and others were hit with RICO indictments. The fund was crippled, mortally wounded, as Thorp put it, and dissolved in 1988. Thorp was furious, apparently put a picture of Giuliani on a dartboard. The Wall Street Journal even compared Giuliani's use of RICO to the Terminator.
But maybe the most famous, most spectacular blow-up of all was long-term capital management.
LTCM.
LTCM, yeah. The ultimate quant cautionary tale. Founded by John Merriweather, who'd run the legendary arbitrage group at Salomon Brothers.
And he brought in superstars, the Dream Team. Nobel Prize winners Robert Merton and Myron Scholes, the guys behind the Black-Scholes options pricing model. It was like having, I don't know, Einstein and Newton on your finance team. Their early returns were incredible, 33% after fees in '95.
What was their main strategy?
Mostly convergence trades, betting that tiny price differences between very similar securities like slightly older versus brand new government bonds would eventually disappear or converge.
Sounds low risk.
Individually, maybe.
Yeah.
But they used extreme leverage to magnify those tiny differences into huge profits. And that leads to the fatal flaw.
Which was?
Underestimating fat tails.
Fat tails. Explain that.
Okay, imagine a standard bell curve graph of probabilities. Most events cluster near the average. Fat tails mean the extreme events market crashes. Massive sudden swings happen way more often than the standard model predicts. The tails of the graph are fatter.
And LTCM's models didn't account for that.
Not nearly enough. They assumed these extreme events were practically impossible, like once in a billion years rare. And crucially, they assumed their hundreds of different trades weren't correlated, that they wouldn't all go wrong at the same time.
But in a crisis, correlations go haywire, right?
Exactly. They thought they were diversified, but when a real fat tail event hit the Russian bond default in summer 1998 panic spread, investors fled all kinds of risk and a flight to quality.
And LTCM's trades?
All their carefully balanced, supposedly uncorrelated positions blew up simultaneously. Everything went against them at once. They lost $4.4 billion, 90% of their capital, in just a few weeks.
90%.
Gone. Merriweather's friend Vinnie Matone told him straight, when you're down by half, you're finished. It was that brutal.
Warren Buffett commented on it, didn't he?
He did. He marveled how these guys, with an average IQ of maybe 170, could lose everything. Said it was like Daniel Bernoulli's warning from centuries earlier. Risking your entire fortune makes you a simpleton no matter how smart you are.
And the media?
They had a field day. Headlines like, rocket science blew up. One writer compared LTCM's computers going haywire to HAL from 2001, a space odyssey destroying their creators. It was a humbling moment for quantitative finance.
There was another similar, though maybe less famous, collapse too, Ifuku Master Trust.
Yeah, John Kuhnman's fund. Ifuku means eternal luck. Didn't quite work out that way. Lost 98% of its value in just over a week. Same story. High leverage, unexpected market shifts.
So the lesson from these collapses.
It's a stark warning about hubris, about leverage, and about ignoring those fat tail risks. Even the smartest people with the most sophisticated models can be wiped out if they don't respect the possibility of the improbable happening. It's that razor's edge between aggressive investing and just total financial suicide.
But despite the blow-ups, the quest for that edge, it never really stops, does it? Let's end on a success story. The Hong Kong Syndicate, Bill Woods and Bill Benter.
Right. A fascinating counterpoint.
Yeah.
These guys became incredibly wealthy, multimillionaires, by betting on horse races in Hong Kong.
How did they do it? Inside information?
Nope. Pure math and computing power. They built a highly sophisticated computer model to find mispriced odds in the giant Hong Kong betting pools. And they used a fractional Kelly system for betting, applying Kelly's principles carefully.
Why Hong Kong?
Because the racing there, run by the nonprofit Jockey Club, was known for being incredibly clean, very little fixing. And the betting pools, the pari-mutuel pools, were enormous. It provided a stable environment where their mathematical edge could actually play out reliably.
Ironically, Bill Woods, the horse racing genius, apparently lost big betting on stocks.
Yeah. The story goes he lost $100 million shorting the NASDAQ right before the dot-com bubble burst. His conclusion, horses would seem to be a far safer investment than stocks. Quite a reversal of conventional wisdom.
So the Kelly Criterion today.
Yeah.
Still controversial.
Very much so. That love-hate thing continues. You still hear those Kevorkian Criterion nicknames. But you also have serious people arguing that someone like Buffett embodies its core principles. Wait for a massive edge, then bet significantly, focusing on long-term compounding. Dillinger's bright, clear line between aggressive and insane investing is still relevant.
So what does this whole journey mean for you, our listener, at the end of the day?
It really highlights that finding an edge with information and math is this ongoing, evolving game. Whether it's cards, horses, or stocks, you need discipline, you need rigorous risk management, maybe Kelly-inspired, maybe something else, and you absolutely need a healthy dose of skepticism, even about your own brilliant ideas.
So we've gone from smoky back rooms with telegraph wires
To brilliant mathematicians defining information itself.
to the highest levels of global finance, seeing fortunes made and lost spectacularly.
And the fundamental challenge, in our world, just drowning in data, it really hasn't changed. It's not just getting information, it's figuring out its real value, understanding its unpredictability, and then managing the risks you take based on that understanding.
So the final thought for you. How will you apply these lessons? How will you find your edge, manage your risk, and navigate this complex, information-driven world responsibly and strategically?